Okay, so hello everyone. My name is Mridul. I'm a consultant here at Desvelado. Today we are going to go through the DCF model or discounted cash flow model. I hope you guys are able to now have a better grip at the weighted average cost of capital and the beta here is not bothering you too much. So today we are just going to learn a bunch of different ways in which we can forecast our cash flows, which as you all know is the blood of the business, and how we can try and use those forecasts based on certain assumptions to be able to calculate what the current price of our equity should be. Now, this is a very important step in any analysis, and typically most evaluations that are done with this method, unless and until your company is private or there are some other anomalies in the figures that are coming up in your company, you will typically go with the discounted cash flow model. In this, we will also run a reverse DCF methodology, basically to see whether our assumptions are in line, and if they are not, what should have our assumptions been to be able to arrive at certain prices, like the current market price. Should it be too different from what our model under the DCF gave us, right? Or so if the current market price differs from our intrinsic value that our DCF model is giving us, we basically backtrack in the process and find what assumptions should we have taken to be able to arrive at the current market price. Okay. So let's begin with a quick example or definition, small conceptual note here of what is free cash flow to the firm. Right. So whenever your company makes a profit, it has an obligation to pay off its debtor, its creditors, which is the people or the institutions it has borrowed from, in the form of an interest. And at the same time, once that interest has been paid, the taxes are paid. The remaining last profit lies with the equity shareholders, who are the ultimate owners of the company. So in that sense, free cash flow to the firm is calculated by your earnings before interest and tax, and you simply remove tax from it. Now, this is the first stage of calculating free cash flows. Then the next step from this is basically all the cash that is coming through operations into your company. So this is also called earnings before interest, but after tax. Okay. But the street name or the more used name is net operating profit after tax, so no PAT. Okay, so this is the first step in or the first figure you have to arrive at in order to reach your free cash flows. After this, you will look here. If you look closely here, as we move forward beyond NOPAT, we realize that, hey, when we were calculating our profits, we actually removed depreciation. And our depreciation is simply writing off of assets slowly as they get more and more used during the span of their useful life, but we don't actually pay depreciation in the form of cash to anybody. So nobody is collecting that cash from us. So it's a non-cash expense, and non-cash expenses should not be reducing the value of our free cash flows to the firm. So since net operating profit, or no PAT, net operating profit after tax, is calculated after we have subtracted depreciation, we will now add it back in order to arrive at a more accurate figure. Now the next two steps are quite important. We look at, up until depreciation stage, we only looked at what was going on in our income statement, but there are multiple items in the balance sheet as well that have actually made us either utilize or earn some cash. So although these don't really figure into profits necessarily, they do have an impact on cash, and thus they have an impact on the free cash flows. So the next step here is to look at the capital expenditures. So if we are spending money in order to, let's say, increase the number of buildings or equipment, etc., under our ownership, then we say that there is a net capital expenditure or net finance investing activities outflow. So we will minus capex, and then we will also remove any changes in working capital. And there is a very specific reason why we actually reduce working capital as opposed to adding it. So two main or representative pointers here that you can collect from working capital is that working capital is basically current assets minus current liabilities. So let's just pick one element from each of that category and see why we are subtracting working capital. Now, anytime you increase your current assets, let's say trade receivables, if they are going up, that means you're not collecting any money from your debtors. Although if they are doing business with you, you will surely count them as your revenue. But if you haven't collected any money from them, you're basically making a payment to them or getting your cash stuck with them. So it's a decrease in our cash levels. Similarly, if the payables or trade payables are there, where you are doing some business with some vendors who provide you with supplies, etc., and let's say you haven't paid them money. So this is actually ensuring that your cash stays with you, and in a way we can consider it increasing our cash balances. So what happens when we have net working capital? In the formula, you can say current assets minus current liabilities is our net working capital. So in the event that our payment to the debtors or does not come through, payment from the debtors does not come through, more and more of our money is getting stuck with them. And if we keep making payments to our creditors, then in that case we are actually paying off and further decreasing our cash balances. So looking at this, if the value of net working capital is negative, which means that we have actually collected some money from our debtors. So next element that we look at is the change in net working capital. It's not directly the working capital that we are changing, or subtracting. We are looking at the change in working capital. What this means is that if you look at the two elements of working capital, which is the current assets and the current liabilities, what happens is when current assets increase, for example trade receivables increase, it effectively means that we are having more and more of our cash getting stuck in in form of trade receivables. We're not getting any cash, although we are dealing with the debtors, and we are surely counting them as our revenue. And that increases our NOPAT. But at the same time, since we did not actually get the cash, we want to reduce it. All right, we want to remove that non-cash debtor creation from our free cash flows. And at the same time, if you look at current liabilities, in case we pay the current liabilities, of course our cash balances go down. But at the same time, if we do not pay our cash balances, our trade payables, then it effectively implies that we are able to hold on to our own cash, and that adds on to our free cash flows. So if the payables have gone up, we've actually in a way earned some cash, and that is then therefore added back to the free cash flows. So if we look at this, the reason why we are subtracting working capital is because we want to look at change in current assets and minus change in current liabilities. Now, if you look closely, this element is, if it is increasing, it actually is negative for us, and if this is increasing, it is actually positive for us. So when we subtract working capital from our NOPAT, what happens is the increase of current assets is considered to be a negative impact on free cash flows, and the increase of current liabilities, because there's a minus sign here and here, it actually ends up making it positive for us, which is the case because by not paying our trade payables, we have effectively been able to hold on to our cash, and that increases our free cash flows. Right. So I hope you have understood what the formula for this is, and ultimately when you have calculated all of this. Okay. So this is the formula for free cash flows. Now we look at how we have created this. I'll go line by line over this particular module and how we have actually generated all of these figures, and why we have calculated what we have calculated, and up until what point do we need to forecast, and how do we decide to do that. Okay, so let's look here. All right, so we'll create 3 sheets to do our DCF and reverse DCF modeling. So these 3 sheets will be called revenue sheet, NOPAT sheet, and FCFF sheet. So what it effectively means is that when we are at the revenue sheet, everything here starts off at the point of revenue. Okay, which means that the one rate that we are bothered about is the rate of growth in revenue. Everything else we can make a superficial assumption or even a deep assumption, but the main concern here in this particular sheet for revenue is the growth rate of revenue. Okay, so this particular line is the most important for us when we are dealing, when we are conducting our discounted cash flow modeling at revenue sheet. Similarly, when we look at NOPAT, if you look closely, the revenue has stayed the same. All right, but the main concern becomes our growth rate in net operating profit after tax. So in this case, if you look closely, our NOPAT is very different from what you are seeing here. And the reason is that for this NOPAT sheet, we have made a separate assumption about the growth rate of NOPAT, which is not dependent on revenue. So our NOPAT is not flowing down from revenue. In this case, we are using a rate to increase NOPAT as opposed to going through the stages of revenue, EBIT, and then tax, etc., like was the case in here. Okay. Similarly, free cash flows here, even though we've mentioned revenue, you look, as you can see, we've straight up taken free cash flows from the last year and grown them at a particular rate. We have not taken, we are not worried about what revenue is doing here. We actually want to see how our cash flows behave given a particular interest rate. All right. So let's begin. So this particular year 0 is the final or the latest year of actual values that we have available with us. If you look here, I can take you to so if you look here, the year 0 data is coming from FY24 financials that were reported in March of this year, and then everything else is actually forecasted from here itself. All right, so we are building this model up on our final or the latest actual values available. We may use the previous years reported to arrive at a particular rate given the trend in the past, but at the end of the day, when we try to extend this data forward, we will be using the latest year and not any other year from the past. Okay, so let's look at how we arrive here. So here's your revenue. It's going to be in crores, and here's your growth rate. Again, if you're making an assumption just like this here, the 7.06 is an assumption. We have arrived at it with some reasoning. So you should be mentioning your reasoning here. Like I've said here, growth rate has been calculated as CAGR of FY22 to 24, even though we have the data from 2019 to 24, as the company showed sudden boost in revenues in FY22, post which it has been unable to display similar results, indicating that that it is unlikely to repeat such a performance. So if we go back here to the final figure, I'm just going to pull the sheet all the way to our revenue sheet. Okay. So if you look at the changes in the revenue, if you look closely, the revenue growth, which is this year one upon year zero minus one in percentage terms, here it is 3%, then it goes marginally above to 4%, but then suddenly we have a rise in of 32% in the revenue. This marks, this raises my suspicion. So what happened here? So if you look closely in the balance sheet, you'll see a similar trend in trade receivables. So which means that the company started to take orders and allow the other party to not pay up right away or in a short span of time. So if you look at here, trade receivables, yeah, so it went down, and then you can see the sudden increase here, right? So if I were to look at the pattern of this, let's say minus this, all right. So you can see here that even though in from FY19 to FY20, the trade receivables went down, which means the company actually collected quite a bit of money. It suddenly shot up to 32% and then has maintained that trend ever since, which means, and even went to 35% in FY24. So its policy with its debtors has gotten more and more lenient, and that is the reason we are seeing that the revenues have all of a sudden spiked up. So in this case, we will what I did, I selected the revenue, the CAGR, or the compound annual growth rate of FY20 from FY22 to FY24, because I do not think that the company will be able to perform the same way it did when coming from here to here. It is still a more optimistic assumption, because as you can see that the growth rate of revenue has come back to its or actually fallen lower than the marginal increase years when it was private back in 2021. So so it makes sense that I do not rely on this 32% and don't just take an arithmetic average of these growth rates. I should rather look at what pace it increased in a smooth manner over from FY22 to FY24. Right? So that forms the basis of this particular 7.05%. Now I've hard coded this over here because eventually this will be changed multiple times. And if you do hard code, the conventions of financial modeling dictate that you should make the color of the text into purple or blue, so that anybody who is reading the model is easily able to identify that this here is a hard-coded figure and does not have to go through the pain of looking around what is hard-coded and what is not. Okay. As you can see, any of the hard-coded figures here are actually blue in color. Right. So next line is EBITDA margins. So in this case, EBITDA margins, we have relied upon the full set of data that we have in terms of our actuals. So I've actually taken the average of the EBITDA margins here. So Okay. So what we did here is G16 at 16. Okay. All right. So in this case, we've used the forecasting average instead of the actual average. Here, we've taken the forecasting average, which is 15.31, as opposed to this average. The reason is that we assume that when our sales is growing, typically our expenses will also grow, right? So we take an average of this particular thing from here. Okay. So since for the revenues growth rate, I've just taken a CAGR of this. I'm going to take the CAGR. I'm just going to take an arithmetic average of the expenses for FY 23 and 24. And this arithmetic average is then carried forward to the forecasted years of 2025 to 2029. Again, you can use your own basis to form the reasoning. I just see a pattern here that the expenses as well. So this here is the growth rate of expenses, and if I look at it over the years, it's not really going that quickly anymore. Apart from the year in which they had a surprising boost in revenue, they actually have slowed down in total expenses as well. So the growth rate is not being as much. So it could possibly mean that they are now slowly reaching to a point where they are better able to utilize their current assets to be able to generate slightly higher amounts of revenue. But it also indicates that they actually haven't scaled up their operations in a way that the expenses increase at a rapid pace to be able to boost revenues further. So what I've done is I've just simply taken an arithmetic average of these two figures here. So FY23 and FY24, and that becomes my persistent set of expenses or proportion of expenses of the forecasted revenues as well. So once I've calculated this, I've extended this forward to each of the forecasted years, and then calculated my total expenses based off of the percentage of based off of the growth from the previous year. So if you look at here, so 6%. So now, because this is growth rate, this is my average growth rate, and I feel that once we hop from 24 to 25, we are going to experience an increase in expenses from 1437 to 1524 based off of this particular rate. So since we are not deriving this particular expense from the revenue, we are simply looking at the growth rates of the expenses, right? And that's how we arrive at the EBITDA of forecasted years. All right. So similarly, employee costs, etc. You can typically increase it forward, but in my case, I just wanted to look at depreciation because a company might be able to hire more people, or might go through a series of layoffs. So in my case, I've just simply forecasted the depreciation here, and to do this, I've actually created a depreciation schedule, which we will quickly go over in the next few meetings or videos. So if we look at, right. Okay. So, I'll come to the depreciation schedule in this video itself. So what has happened is I've calculated my depreciation to be 7.5% of the total assets, and what I'm going to do is I'm going to apply that depreciation in the coming in the forecasted years. So this actually is not of the assets. I believe this is based off of what we have been paying conventionally. Typically, if you look at what is based off of assets, it will show up as accumulated depreciation on your balance sheets. All right. So once you've reduced the depreciation, again, if you want, you can extend these forward to your forecasted years. But in my case, I'm just going with the depreciation expense, and I feel that my EBIT should be changing to these figures. So now that we have arrived at the EBIT, we look at what percentage of revenue they are forming of. So since in our revenue sheet, everything over here should flow down from revenue. Okay, so what we're going to do is we're going to calculate our EBIT based off of our revenue. Had this been an EBIT sheet, had this been a sheet from the EBIT, what we would have seen is that we now apply a separate independent assumption to the changes in EBIT going forward, and then use that over here in our EBIT. So this rate would not be dependent on the portion of revenue. Okay, this would have had a totally different meaning. But since EBIT as a line item is very much dependent on revenue, we just use this sheet as a revenue sheet as opposed to an EBIT sheet, and then go from there. Okay. So EBIT margins, we have our EBIT margins continuously changing here. Okay. This is because after the expenses, once we have reduced our expenses, so these figures and the depreciation, we are able to arrive at a figure for EBIT, and we look at the proportion it forms for each of the forecasted year's revenue. Now we want this particular average. We want to average the EBIT margins for each of the forecasted years, and then take one single rate that will form the basis of actual forecasts in our DCF model. So here, if you look, we have taken the average of financial statements. If you go here, yep. So this is the average that we have taken, 15.31. By the way, if you wish to understand how I reached there, you simply hit Control plus the square open bracket to arrive at all the cells that this cell is deriving its inputs from. So you hit this, and Excel is very kind to highlight everything that every cell that we are using as an input in the calculation of this particular value. Okay. All right, so we have EBIT margins, and this is our, okay. So had this been an EBIT sheet, what you would have seen that we could have taken a CAGR and then increased this particular value of 125.19 and jumped forward one after the other. But since this is a revenue sheet, so everything post revenue has to be dependent on the revenue. Okay, because in the end, when we will try to play with this particular number, we want the entire sheet to respond. If you make everything else from here on independent, it will not really give us any value. So we have our revenue setup as dependent on the CAGR. If you look at here, it's dependent on, everything is dependent on something or the other in revenue. All right. EBIT margins EBIT values are dependent on revenue. Again, we have our basis for EBIT margins. So make sure that you add a note here. How to add this to this superscript 2? You basically, in anything, let's say you want to write EBIT here and you put 2 here, just do shift and just select the 2 in this particular thing. Right, in this particular cell text, you simply select the 2. Now hit Control 1, and you'll see a superscript here, and you'll be able to make it into a superscript, and that's how you reference it down here. Expected EBIT margins have been has been taken as the average margins obtained from FY 19 to 24. It's actually not FY 19 to 24, it's from forecasted. $25 to $29. So you basically make sure that your notes are correct so that anybody reading this model in the future knows why you arrived at that value. All right. It's okay if the explanation runs long. You can always simply just expand this and do Control-HW so it can come in this way. It can basically wrap the text inside the box. But other than that, you should have a sound basis. That is more important than the formatting here. Okay, that can be handled at later stages. All right. So now let us look at where we have reached here in our modeling. So after doing everything that we have discussed, we arrive at our FCFF. So after reaching at NOPAT by arriving at EBIT and then reducing taxes. So even though the sheet is dependent on revenue, and we'll later just play with revenue only, it is more important that we start to look at the figures that are actually involved in the calculation of NOPAT, which is again your net operating profit after tax. EBIT, earnings before interest and tax, we have 125.19, right? Again in rupees crores, and then you reduce the taxes here, and this gives you earnings before interest. So you have not paid interest, but you have still removed the impact of taxes from all the cash flows. All right, so that gives you net operating profit after tax that belongs to both the equity shareholders, and the interest portion belongs to the debt holders. Now, as we had discussed, we'll add back the non-cash expenses because we don't want them bringing down our free cash flow calculation. They are not cash flows, so but still they have been reduced from net operating profit, so we'll add them back. So 21 crores is added back, and then we basically reduce our capital expenditures and a change in working capital. And again, we have already explained here why we are reducing the change in working capital. If you wish, you can rewind and take a closer look as to why we did it. Again, I'm always available on my desk if you have any conceptual or modeling doubts, and let's move forward. So once we have our FCFF, now we want to be able to look at what our FCFF is going to be in the future. So if you look closely, we have actually been able to forecast each of these things based off of the estimated items or our assumptions. So all our assumptions here, our tax rate in the previous year was 26%, and unless and until there is any indication that the taxes are increasing, you can go ahead and choose the same rate. So our taxes are dependent on are charged on EBIT, that is earnings before interest and tax. That's the profit that the government feels that it can actually charge us. But again, there is a small error here that we should actually be marking this earnings before this tax rate on earnings before tax, not earnings before interest and tax. So we could have actually removed the interest costs or projected our interest costs as well and removed it from this line item, and then charged our 26% tax on that. So this figure is right now overstated because we're not making the use of tax shield. So but for the sake of learning, you can see that we have used our tax based off of the current tax rate. Now NOPAT here, we arrive at NOPAT for the projected years, which is year 1, year 2, year 3, year 4, year 5, and then we can calculate a NOPAT margin, but it's basically going to be the same because everything here is dependent on a single percentage, so not much is going to change from here to here. And Then again, you go through the depreciation, capital expenditure, and working capital, and then arrive at your FCFF, which is the free cash flow to the firm in the projected years. Now, if you look closely, that what we are trying to say through this model here is that, hey, we are right now in 2024. In 25, 26, 27, 28, and 28 and 29, we're going to earn free cash flows of 305, negative 90, 495, negative 62. I know it's a bit erratic, but just bear with me. And then positive 525. So these are the cash flows that we will be seeing in future, in the coming years. So I want to basically, what I'm trying to do is I'm trying to value the company today. So what is the value of my company this year is what I want to know, right? So, so what I do here is I have to now apply the principles of time value of money and get this particular free cash flow to the present day. Okay, so I'm sitting at 2024. I want to see what all of this sums up and comes down to. Now, there is a reason we have only taken 5 years, although it's incorrectly been taken as 5 years. How will you decide whether to take a 5-year forecast or a 6-year forecast or a 12-year forecast? So for that we have a method. Like I said, there's a method to the madness. So in the final year, if you apply the Gordon's growth formula, we basically say that, hey, our company, for example, will grow at a certain pace or will grow at an unknown pace. Ups and downs will happen till the year 5, and after year 5th, in perpetuity, because a company has an indefinite life. So beyond this point in the company's indefinite life, we feel that the company year on year as an average at least will grow by 4%. All right, so this becomes your growth rate. So this becomes your growth rate, or G. Right. Now, in the previous chapter, we found out our weighted average cost of capital, or WACC. So as you can see here, our WACC came out to be 1.39. So you can just go ahead and, just for the understanding, I'm noting down things here. This is not the part of you don't have to make such changes to the model. Your model is going to be the same as what has been shared before. All right. So typically, cost of capital, or weighted average cost of capital, is typically more than your growth rate. So just for the sake of understanding, let's take the WACC as 10%. Now, what we say here is that I want to discount this perpetuity. Okay, the free cash flows that we arrive. If I keep extending this table, right, this can go to infinity. So we assume that there is a growth period here, which is called present value of growth years. Okay, this is all PVGY. So these are our growth years. We assume that the company is going to perform much better in these years, or at a higher rate than its perpetual rate of growth, which it can happen because the company is too concentrated, or it becomes so large that even a 4% growth rate per year is a very good growth rate given the size of the business that the company is doing. So this is our present value of growth rate, and we look at this here. This is the weighted average cost of capital. So we want to know that, hey, if I were to extend these forecasted this FCFF further into the future, assuming that beyond this point my company performs at a plateaued rate of 4%. It grows by 4% every year, neither higher nor lower. So what we do is we look at the final years free cash flow, and we basically bring it forward to 1 year. So we bring it forward to year 6. How do we do that? We take this particular growth rate. So we take this particular growth rate and multiply that with, we say that this is the year that it's going to start increasing at its perpetual growth rate. Okay, so this is our free cash flow on the year 6. This is right at the beginning of our perpetual growth rate period. So okay, yeah, so FCFF year 6. Now what we want to do is, now that we have FCFF in year 6, we actually want to apply the time value of money concept in such a way that we get the value of all of this forecasted free cash flows, including the year 6 one that we have just calculated, back at year 5. Okay, so we want to sum up all of this, and we want to put it at right this place. Okay, so if you have learned it in mathematics, the formula for perpetual growth rate, perpetual compounding, it's actually rather counterintuitive. It's, you basically go ahead and divide it by the rate at which you are the net rate or the net increase that is expected in the year 6 free cash flow. So basically the present value or the value today for or the value at year 5 for this year 6 and beyond free cash flows will be calculated by year 5 for FCFF in starting year 6 to, okay, what you simply do is you take this particular figure, you take this figure and you divide this by 10% minus your 4%. And there you have it. So this 9,108.92 crores is representative of all the years of future cash flows that the company is expected to generate in its lifetime beyond year 6. Okay. So remember, this is now sitting at year 5 after being discounted this way. After getting divided by 10 minus 4, it is no longer sitting at year 6. It has been pulled all the way back to year 5. So not only do we have the free cash flows of our of the last year of growth years, we also now have the present value of our perpetual years sitting at alongside this particular figure. Okay, so this is how we'll calculate. Now we have to pull these figures. So just for representation, let me just put it here and bold it out. So on year 5, now we have 2 cash flows sitting, free cash flows, and on all the rest of the years, 1, 2, 3, 4, we have 1 cash flow sitting each year that is going to that now needs to be brought to today's period. Okay, so now we need to get this. We need to get all of them to today's date. Okay, that will be called present value of free cash flows in the future, right? So yeah, I don't need this anymore. I hope you have understood the concept. In my case, if you look at, okay, so this is called the terminal growth rate, the or the perpetual growth rate. Once your growth years are over, this will be your perpetual growth rate. Again, you have to have a basis for the 4%. In my case, most developed economies, and companies do not increase at a more rapid pace than 4%. So we've taken 4 here. Otherwise, if you have another sound and more deeper reasoning, please feel free to do so, and don't worry about what this tells you ultimately. Okay. Again, I took 10% here just to conceptually explain to you what would happen and how you would discount the values. Of course, in my case, the weighted average cost of capital came out to be 1.39%. So that made this calculation unfeasible, because you have to divide this particular number, this 546.54, by -6%, and that doesn't really give us any logical figure to be considered as discounted free cash flows. Okay, so now we look at here, we've done the same thing. As you can see, 546.54 by multiplying 525.51 into 1 plus 4, which gives us the 6th year's free cash flow. And now what we do is we try to calculate the terminal figure. Now, if your cash flow is, if your K minus G, or WACC minus growth rate, is actually negative, as it is in this case, you can go with an exit multiple. In my case, the exit multiple is 3, and I'll come to it quickly as to what the exit multiple, how we can arrive at the exit multiple. But right now, let's just continue with the DCF model as it is. So we've calculated our terminal value at at year 5. So you can consider this particular thing here is coming due to the exit value being a multiple and not a discounting rate. My free cash flows actually arrive at year 6, and then I have to discount them one extra year. But in your case, should the WACC be more than growth rate, and you apply the FCFF into 1 plus G divided by a WACC minus G, should you apply this particular formula, make sure that you understand that with this formula, your discounted value of perpetual free cash flows after the growth years is going to be on year 5. Okay, so you only apply a discounting multiple of 4, and we'll just look at how we have calculated this. So this, from here on, it is simple maths of compounding. We want to look at G31, which is the terminal value, and we add 1 plus WACC. So now when we are pulling it all the way back, we don't apply growth rates. Those growth rates have now been factored in. Okay, you grew this particular cash flow by 4%, by a certain rate, then by a certain rate, then by a certain rate, and then finally from year 5 you started to grow it by 4% every year. So growth rates have been factored in. Now when we pull all of this back to the present value, we'll look at the weighted average cost of capital, because this is the rate, this is the minimum rate at which our free cash flows should be generated. This is what both the debtors and the equity shareholder, the creditors and the equity shareholders of the company have been demanding from us. So we discount it by, we divide the terminal growth rate, terminal year, final year rate value by 1 plus WACC, and then for however many years we are going to pull this back is going to be our free cash flow sitting right at the current year in which we are. So you can see here that I am pulling it 5.5, and the reason I'm not doing 6 is because all these cash flows happen throughout the year. So it would be unfair to assume that this is happening right at the end of the 6th year. Okay, if I were to make this 6, what happens is we are telling the formula that, hey, this particular cash flow actually happened on 31st December. Let's say, for example, if your accounts end at in calendar years, that, hey, it is ending on 31st December 2020 or 2030. So I will be discounting this back by 6 years. But in reality, what happens is your cash flows happen throughout the year. So for that, we apply this half year convention. So instead of going with 6, we go by half year, that at least at half of the year it is done. We have earned our free cash flows. So now we're going to discount it back by 5.5. So it gives us a fairer picture of how much time we are actually spending to earn those cash flows. Some of the cash flows may have been earned in the first 3 months, some in the next 1 month, another bit of cash flows can be earned in the next 2 months. So like that, we just assume that we are earning right at the middle of the year for the cash flows. So now that we have discounted the terminal value, we will also apply our discounts in a similar fashion to each of the free cash flows in the growth years that we had calculated. So again, this is the closest to our current year. So this is 1 year ahead, but the cash flows will happen half a year into the future. So therefore this is 0.5. Similarly, this is 1.5 because this is 2 years ahead, but the cash flows end up happening after 1.5 years. Okay, so half of this year and 1 full year later, we'll get this particular cash flow. And then 2.5 because this is 3 years in future, but within half of the 3rd year, we'll get these cash flows. Okay, so we discount them. Basically, this I-19, this 0.5 becomes the exponent or the number of times we have to discount our free cash flow of the future at the rate of our weighted average cost of capital. Okay, so this is our formula. As you can see, we are discounting it back to the present. So these values, all of these values, because of this being 4.5, this being 3.5, all of this, what it ensures is that all of these values are actually now derived from the future values of free cash flow and are actually sitting at the current year. Okay, so all of this is current year free cash flow that we have forecasted. Similarly, terminal free cash flow we have forecasted over here. Okay, so now what we will do, we will basically say that, hey, so we'll sum all of these free cash flows of current year that we have calculated in one line, and then we'll calculate the present value of the terminal growth rate. Okay, and then we'll look at the total enterprise value. So we'll say that if we were to value our company today based on cash flows, this is what we think is the earning or cash earning potential of our company. Okay, so this and then this is added. These two figures are added to give us the total enterprise value based on our forecasts and our assumptions. All right. Then we look at the equity value. So now this belongs to all of the owners or quote unquote creditors and the owners of the company. Now, if I was to buy this company today, what would I do? I would basically say that, hey, you have this much debt and you have this much equity. If I'm going to take on the debt, I basically want to see how much equity, if I buy this company, I would have to pay off some of the creditors, etc., etc. But how much will be my ownership in the company? You know, if I was to I just want to know what is the equity value that I'm paying for. Okay, so for that, you further reduce net debt And what net debt is basically, it says that your company has a lot of borrowings, but your company must also be holding some cash. So, theoretically or hypothetically, I can actually use the cash in your own company and pay off some of your creditors right away. That is why when we are trying to find out the cash value of our equity, we subtract net debt from total enterprise value, and that gives us the equity value. Now, based on free cash flows, this is the value of our equity. If we divide it by the number of shares outstanding, we get our final intrinsic price, which is the result of your DCF modeling. Okay. Now, coming to how many years will you forecast this? How many years will you consider present value growth years to be forecasted, and then where does the perpetuity year start? So to do this, you actually have to take on some years. The convention is 5, and calculate the free cash flows from that year, and look at the terminal year. You have to look at the discounted value at this particular year of your cash flows, and you have to sum the cash flows up until year 5 for the growth years. So we have already seen this. Let's sum it up. Okay. Now in this case, there might be a small error, or I may not have done it based off of that. So the projected years of free cash flow growth is 1,173.84 crores, and then the discounted value up until year 6 is basically this. Okay, and you just do a total of both of these, and this is the figure that you see. Now what I want to see is if what I am seeing in this particular growth years. Okay, let me just and this is okay. So growth years and the present value of perpetuity till the growth, the 5th estimated year is this, right? So now I want to actually see what percentage does it form for the total cash flow. Okay, so as you can see, our growth years are only able to capture 42% of the expected cash flows. Okay, so there is an issue here. I don't want to basically rely on the perpetuity assumption to give me the free cash flows. Okay, I want to be able to have at least 50%. So this figure should be at least equivalent to 14.06 for me to be able to have a reliable model here. My intrinsic value should not be majoritarily dependent on the perpetuity growth expectation. It should actually be dependent on my growth years, because what will happen 7 years, 10 years, 12 years from now, I don't really know. Okay, I can only try to look for the number of years that that I feel I can foresee. So in this case, we are using this particular understanding to actually make sure that the free cash flows, the projected free cash flows, are projected up until the year that justifies our. Let's see. Okay, so let's see. Okay, so there are other schedules that have only been projected for the next 5 years, so I actually have to go and then increase the number of years here. Okay, now let's see revenue. This got filled. Then there must be capex, and there's a working schedule for capex. So that is why it is not coming out to be a direct, it's not giving us the number of years, and the calculation cannot be simply dragged to the right, because right at the origin of these particular sheets, which is the financial statements data sheet here, this needs to be forecasted to many further years. Again, you can do that easily by dragging this to the right. Like I said, if you have a column next to it, you select it and you select the other column and you hit Control R. It will operate all of the functions of that particular column to the column on the right, and you can do it for any number of columns to the right as you want. But in this case, I'm just not going, because it'll take a lot of time out of the video. Okay, so I'm just going to bring the model back to what it was. Okay, so like I said, this should be in growth years, we need to capture at least 50% of the free cash flows. Now, once we have our intrinsic value at hand, we'll run hypothetical cases. So at the time of building up of this model, what the current market price was going on as was 150. It is much lower now, so market is again seeing something much worse in this company. And the other cases that you have to see is a bear case and a bull case over your intrinsic value. So whenever we say bear case is if our expectations are actually wrong and the market further makes a sale in this company and suppresses the price. And a bull case is that market sees that we are missing something, and the market is actually valuing it at a higher price. They feel that it can offer more returns in the future. We'll call it a bull case, in which event the price of our share price will actually increase by 25%. So what we do, how we've calculated here, and there's a reason these figures are in blue. So at this stage, we will conduct what is called a what if analysis. What if my price, in implicit price, what if this particular price had to be matched to the current market price of for Western carriers? So we look at 150 and we say that, hey Excel, just look at my just conduct a what if analysis and just look at my data and seek a particular goal. And the goal is that this particular cell needs to have the value of 150 rupees, and do so, attain this particular feat, or attain this particular change by telling me how much should my revenues have grown if to bring my intrinsic price or my model price to 150. So what assumption should I actually have taken to arrive at 150? So once we hit this, if you go to the right, you can just hit OK. So you'll see that it says that your revenues should actually be decreasing to attain that particular value of that particular intrinsic value. And here you can see it has made our intrinsic price equivalent to our market price. Okay, you can just hit Control Z and it'll revert everything. Thank God for that. Otherwise you would have had to go back and manually punch in, and God forbid if you forgot what your rate was, it would have been very difficult since it is manually punched in here. Okay, now for the intrinsic price, the second scenario, we don't actually need to do much. This is actually your DCF price, so not your reverse DCF price. Now comes the bull case and the bear case. So it's the it's the same thing that you have to do in order to be able to attain to these prices. So pardon me if the prices aren't really coming out to be the same, because we've changed a lot of assumptions along the way. So some of the figures here may have had a different hard-coded value at the point at which these figures were calculated. That's why it's not showing 9.82. So once you calculate, once you run the goal seek, just make sure to make a note of somewhere in your register or your notepad that for current market price the value should be 9.28, and then just enter it here. Okay, I'll just do it for you. 9.28. Okay, we know 7.6 is the current intrinsic rate of growth. And then moving forward, for the bear case, you do the exact same thing. You go to what if analysis, you request Excel to run a goal seek, change my intrinsic value to 176.89 by making a change in the cell of revenue growth rate. Again, we are running a change in the revenue growth rate because this entire sheet is running from revenues. Okay, and we want to see the changes in revenue. If it was the NOPAT sheet, you would have changed the NOPAT rate and not the revenue rate. Okay, so whatever sheet it is, whatever name of the sheet it is, you are going to change the growth rate of that particular line item. And there we have it, 176.89. We need a negative growth rate of 3.14%. So that becomes your next item, 3.14. Okay. Similarly, if you were to run a goal seek at this particular bull case, it will be 14.74%. All right. So this marks the beginning of your DCF modeling, and this is the first stage of your completion. In the next steps, I will be teaching you about different cases as to how to go through what to do if your cash flows are negative, as it was in my case here, and what to do in how to create your NOPAT and FCFF sheet. The NOPAT and FCFF sheet are pretty similar to what you saw in the revenue sheet. Again, because it is a NOPAT sheet, your NOPAT assumptions will be independent of the revenues, and in the FCFF sheet, your free cash flow growth rate assumptions will be independent of the revenues. And then in the very end, you will basically note down the results. These results of each sheet. So as you can see, once we did the modeling, DCF and reverse DCF, we basically noted down all of the rate of returns here, and we have these will eventually form a constraint for us to run a solver equation and then find out the current price, which will basically factor in all of these inputs and give us one particular value for our stock. Okay, so next session we will be covering how to create the working capital, capex, depreciation, and sheets. I'll tell you in the scenarios what to do when your free cash flows are actually negative, and what this 3x actually stands for, which basically comes in handy if your WACC is less than your growth rate. And yep, that's all for today.